Let's bring in Ken Gishinga. He's the chief economist at Mentoria Economics. He's joining me now in the studio at the moment. All right, so it's been a really hectic 24 hours, but let's start with your impressions of this decision to raise rates by 50 basis points. The general consensus was maybe they're going to hold, but they raised. Your thoughts?
I mean, many analysts expected the central bank to maintain it because of inflation being anchored, but the exchange rate issue has been a problem, particularly on the public debt side and on imported inflation side. So in as much as the shilling appreciated last week, I think they needed to see almost 2 months of currency stability before they can.
But that always brings it back to the original question, right? If I mean, the CBR's link between that and the real economy, because what's more effective, raising the CBR or having rates where they are now? Treasury bills, short-term rates around 16%. We've seen infrastructure bonds and medium-term bonds coming into the market at 16, 17%. Those are really high real rates that we're talking about. So isn't that more effective at drawing in foreign capital into the market?
Well, that's a good point, Ram. I'd say we have to make a difference between fiscal policy and monetary policy. What you talk about with the government debt auctions, really that's managing government borrowing, and that's on the fiscal policy side. What the central bank rate is supposed to guide monetary policy. So to your point, high government securities can attract FDI, hot capital from the US and abroad, but really the primary objective of those debt auctions is to manage government borrowing. So it goes back to a big story that played out last week on CBK versus Treasury, the roles starting to conflate. But
they're
I think
going in the other direction.
It's very, very important that the principal avenue for monetary policy is through the central bank rate.
Okay, let's talk about NPLs though, because people will see headlines like this and just think, oh man, I'm just waiting for that email coming through from my relationship manager at my bank. Oh yeah, we've adjusted your interest rates to be X, Y, Z. But NPLs have been particularly sticky, right? They're essentially dipped a little bit, 15.3% in December, down a little bit after that. But between the income losses that we saw last year, the Federation of Kenya Employers is talking about 70,000 jobs that have been lost. The Kenyan currency down 30%. The prognosis for the private sector looks very, very weak. Should banks start holding more capital?
Well, the good news about Kenya is, well, I don't know if it's good news, but the policy transmission signal is a bit weak. So unlike in the US, in the UK, where everybody has a mortgage, everybody has a credit card, and when interest rates go up, you feel it instantly. In Kenya, that policy transmission is a bit slow. Most people don't necessarily borrow from banks. People with mortgages are maybe about 30,000 people. So that lag effect, I think, might still be beneficial for Kenyans. But you're right, NPLs are high, manufacturing companies are hurting. But there's an opportunity for banks to look at their reserve ratios and see where can they be able to tap into some of that to be able to help out on, particularly on the provisions.
I'm actually glad you raised manufacturing, because looking at some of the data that the central bank governor was talking about earlier today, they say that private sector lending is fairly robust. 13.9%, I believe, is the number that he was talking about in nominal terms, not adjusted for the depreciation in the currency. And manufacturing is right at the top with, I think, a 20% increase. But what should we make of that number, considering the fact that we know that a lot of manufacturing firms are struggling just to get a lot of working capital, partly in response to the taxes that we saw coming in June?
I'm very hesitant looking at private sector credit growth, because a big chunk of it sometimes is tied to real estate. So when you remove the non-real estate component and look at active enterprises like manufacturing companies, it tells you a different story. But of course, manufacturing companies are hurting. The excise taxes are not doing them any favor, and the big brands are all showing reported drop in profitability. So it is a concern. But as I said, banks have, if the CBK can come up with an avenue of saying the reserve ratios don't have to apply every month, maybe it could spread out over 2 months so that you maintain that ratio over 2 months. I think banks can tap into a bit of liquidity to be able to help them through that.
Why not just make it a decisive cut and say, look, at least for the first 6 months or for 3 quarters of the year, we're just going to essentially have a CRR cut?
Well, I mean, if you look at COVID, that's actually what they did. They cut the reserve ratio, and we saw a bit of liquidity getting into there. I think the challenge, though, is right now much of banks are still lending to government entities. If you look at percentage of public credit towards the total bank lending, it's at an all-time high. So the private sector still remains very subdued, very crowded out. that any talk of a meaningful growth in the private sector, I think, is still a premature conversation.
And I'll get into the Eurobond question in just a moment. But given everything that we've discussed, it sounds, especially if you're a tier 2 or a tier 3 lender, it sounds like this would be a time to look at your capital adequacy requirements and say, look, I need to probably hold a bit more tier 1 capital, maybe a bit more tier 2 capital as well, just as insurance, given the fact that we're in a situation where private sector demand is going to be fairly subdued for a while.
Well, that depends on the risk management of every bank. You'd be surprised. There are some tier 2, tier 3 banks that have NPLs of less than 5% because they're very niche, are very targeted. So I think, I don't think that should be an industry-wide conversation. I think that needs to be a strategic, from a bank perspective, how exposed are we and which sectors are we exposed in?
Right. I want to get back to the question about the Eurobond. So in the last couple of hours, Kenya's government essentially has put out a tender offer into the market saying, look, we're going to do a partial buyback of the 2024 Eurobond. So actually prices on that have spiked a fair bit. They've gone back up to around, 99 cents essentially on the dollar, practically trading at par for all intents and purposes. But at the same time, they're going to issue a new note to essentially cover the costs, right, of that buyback and perhaps have a longer maturity on whatever that new note is going to be. Your thoughts on what we're doing here? I
think it comes down to investor confidence. The government really felt that investors were getting very nervous, very anxious about waiting for June 24th, 2024. And I think any sentiment towards government showing its ability to start getting some of those securities back, I think was supposed to give investors that kind of confidence. I think part of it was also tied with the expectation that global interest rates will start coming down. But if you look at the Fed chairman last week, Powell, in his interview on 60 Minutes on Sunday, he really said, I think it's still premature. March interest rates might not come down, possibly in the summertime. So I think it's a game of who has the best interest rate outlook. I think global interest rates will start coming down in June, not March. So I think there could be a bit of volatility there.
But that being said, because if we are having this conversation in December last year, granted, we had a situation where the Kenyan government has said we'll do a buyback in May. They said that again in June. Then they said that again in November. The target amount kept changing: $1 billion, $500 million, then down to $300 million in November. And none of these purchases happened. So there was a credibility problem, granted, to be fair. But let's park that aside. By then, we already had funding commitments in place from the World Bank, from the IMF, saying, look, by June next year, you're essentially going to have at least $2 billion in hand of much cheaper, longer-term concessional financing. So I'm trying to understand the logic here. If you already have those funding commitments coming in, why do you need to essentially go back to the market and get much more pricey debt at junk rates?
Well, I think there are political concerns too. If you look at December, where the president had promised to begin that program, that same December when the Treasury Secretary was in Parliament being grilled and the MPs were demanding money for the bursaries, and he said we need to reprioritize this. So you feel there is also political considerations. Yes, you get these funding commitments, but governments are creatures of the political environment. So I think in December what actually must have happened is because only a few days later the president came and said MPs will be paid their bursaries. So possibly part of that money that was supposed to be attributed to foreign debt possibly could have been directed to some of the more domestic concerns. So it's an interesting place where a country has to balance the politics on the ground and the liability management and maintaining its credibility internationally.
Well, it's going to be an interesting one to keep an eye on because yields essentially on the 2024 practically crashed today. 14%, all the way from 14% down to about 9.4%. We'll certainly keep tabs on this and update you. Ken Gishinga, thank you very much for your time this evening.